Pristine Capital is traded on the main board of the London Stock Exchange with the ticker PRIS, P-R-I-S. As interest rates fall, the company is hopeful that there will be a recovery in the commercial real estate sector, and that is their focus. I'm delighted to be joined by the Executive Chairman and 7% shareholder, Neil Sinclair. So Neil, before we discuss property, let's get a bigger understanding of personnel. What experience does management have in the commercial real estate sector?
So we've got extensive experience. I've been 60 years in the business. I started my own business, chartered surveying practice, back in the 70s, and I listed that company in 1987 on the main market. I then merged my company 6 years later with a much bigger company, and immediately we bought 3 buildings and raised £20 million on the stock exchange, and that's what we did. I then started another company in the early 2000s, specialising in commercial property and car parking. Car parking was a big thing at the time. I did that, and then with Stanley Davis, who's partners with me in Pristine Capital, we formed Palace Capital back in 2010. We found a little company that had a market cap of only 108,000. And literally in 12 years that we're at the helm, we managed to build a portfolio of circa 280 million. And when I stood down 2 years ago, we actually posted out the best results we'd ever done. And then about 18 months ago, we decided the time was right, that maybe we should have another go and do it again. The stock market was not brilliant. The property market was not brilliant. But that's the time when you've got to get things going. We're very counter-cyclical. Stanley was working with me, was chairman of Palace for 12 years, very successful. Andrew Perloff has come in with me. He's also very successful. He's got his own AIM-listed company, but he's an investor together with Stanley and I, and we're looking forward to make this a success.
So in your experience, Neil, do lower interest rates typically correlate to a recovery in that sector?
So theoretically, they should. You're borrowing less, therefore everything's cheaper. But you've got to be a little bit careful, because often in a recession, interest rates can be quite low. But the property market may not be wonderful, because the one thing that the property market needs is demand. And you need demand. So it's not just lower interest rates. But if the climate is right and interest rates are beginning to fall, they do normally have a positive effect on the real estate sector. But what you have to look for and be very careful of are medium-term rates and long-term rates. You have to look at the 5-year swap rate and you have to look at the 10-year gilt very carefully. And you may have noticed in recent weeks that the gilt rate's gone up a little bit. So you have to be very careful about that. So you can't just look at short-term interest rates. But it is generally positive.
So what's the strategy of Pristine Capital? How does it intend to make money?
When we started Palace Capital 14 years ago, we had a particular strategy. We thought the right thing to do was to firstly find portfolios of properties rather than just one. That's number one. Number two was to focus on buying companies that own the properties rather than the properties themselves. Now, the public at large do not realise that when you buy a portfolio for, say, £10 million, the stamp duty is 5%. So you pay £500,000. But if you buy a company with a property in it worth £10 million, and that company owes 5 million, you only pay stamp duty on 5 million, but not at 5%. You pay it at 0.5%. So in consequence, by buying corporately rather than just buying the asset, number one, you can save a great deal of money in terms of stamp duty. And when we started Palace Capital, not only did we do that, but also, which was very important as far as we were concerned, it had inherent losses in the company. And the company we bought had £22 million of losses in it. So we bought that as well. So in the property market, it is very important you don't just look at the property, You look at the financials and look at what benefits there are. And at my last company, we had a consultant to us who specialised in capital allowances. There's all these allowances that you get, and staggeringly, a lot of people don't claim them because they either don't know them or not aware of it. But we did that, and in our time at Pristine Capital, we actually saved about £12 million in stamp duty, and in consequence, we paid very limited tax from 2013 to about 2019. So in terms of making money, how do we make the money? So when we bought the portfolio, the first big portfolio in Paris, there was one property in there, and there were 24 properties in this portfolio. There was one property in there called Hudson House in York. And Hudson House was a British Rail office building built in 1968. And you can imagine how it looked. It was a brutalist building. It was 80% empty. Everything was wrong with it. But it was in an absolute prime location. But because it was 80% empty, the owner was liable for what we call empty rates and service charge on all the empty space. We got rid of that. We spent about 3 years getting a satisfactory planning consent. When we bought it, it was valued at 3.8 million. When we got the planning consent, it was valued at 17 million. So we had already made a paper profit. So that's how we create value. That's looking at planning. That's how we do it. And we make properties where when you buy them for £1, we've got to make them worth £1.50 really. I mean, that's what we do.
So if you can, Neil, give me an example of distressed real estate and what the company can do to make it attractive.
So what we did, right, in the end, it's what I call shoe leather. You have to put the hours in. And New York is an historic city, and you have to accept it's a historic city. So I spent probably every other week when we made our planning application, going to York, meeting the council, meeting members of the council, meeting local interest groups, that I wasn't this nasty London developer looking to sort of raise the thing to the ground, but in fact looking to improve on what was there now. And I spent so much time on it, and we actually became part of the local scene really. And in the end, when it came to the point that we had to attend the planning committee to see whether we would get consent or not, it was unanimously granted by the council, and we worked with them. And you see all this talk at the moment about planning, but half of it is you've got to engage, you've got to talk to them. And a lot of people don't. They do it on Zoom and all that sort of thing. It doesn't work. You've got to get on the train, you've got to go and see them, and you've got to sit and talk to them. And that's what you've got to do. And that's what we did. And on Hudson House, when we got the consent, my chairman, Stanley Davis, was a very successful entrepreneur. And he said, well, before we rush to sell it and just make a profit, is it worth us developing it? Is there any more money in it if we develop it ourselves? So we thought about it carefully, looked at all the figures, and we saw that there was quite a considerable profit in developing it. The problem with developing it, you've got to borrow the money and all that sort of thing. But we've got very good relationships with the clearing banks. And we secured a £26 million loan from Barclays Bank to develop it. We did develop it. We didn't expect COVID to come halfway through, but it did. But my experience is that you have to cope with these things and deal with them. And in the end, we only finished 3 months late. And within 12 months of completion, we had sold 80 apartments. We had let 75% of the office building. We paid the bank off. It was a roaring success. I mean, so, but in the end, it's shoe leather and engagement.
So in a nutshell, is it to buy distressed, do it up and sell, or is there any element of wanting to become landlords in perpetuity?
We don't want to be landlords in perpetuity because in my industry, you never ever say nothing's for sale, theoretically, because if someone comes along with a really silly offer, you got to think about it. And when I was at Palace, we actually sold a couple of buildings at prices quite in excess of what even we thought they were worth. So it's worth it. But remember, with distress, people forget what distress is. There's different types of distress. There's a distress where the bank are owed too much money, and very often the bank are owed more than the building is worth. That's distress. But you've also get distress. As an example, in 2016, people forget, when the date of the referendum was announced in 2016, there was an absolute flight from real estate. And there was these open-ended funds who suddenly had applications for redemptions in cash. And these funds only had a certain amount of cash. So they had to suddenly sell a number of their buildings in order to raise cash. Everybody knew they had to sell, so of course they sold them at distressed prices. I mean, that was distress. And that's what happened. And we were fortunate that at that time, we were trying to buy a property in the middle of Manchester, which is doing incredibly well at the moment. And we couldn't get near it. But the minute this happened, everybody disappeared except us. We saw there was a great opportunity to buy a building only 3 minutes from Manchester Piccadilly Station at a very competitive price. And that's what we did. So, and we think those opportunities are around now.
So in terms of your first acquisition, when do you have to make it, and are you region or size specific?
So in terms of size, there are rules with regard to the main market. So we're on the main market, not on AIM. And the main market rules are very specific. You have to make an acquisition of at least £30 million. Now, technically, we've already raised 1.2 million in 2022, so it's actually 28.8 million. But it's got to be that sort of figure. So we're looking to buy a portfolio or a company with assets in it between 30 and 50 million pounds. That's what we're looking to do. It's what we call a reverse takeover. And we're talking to some various parties at the moment. So have we agreed one? No. If we had, we would have announced it. But we're talking to three. And it's the shoe leather thing again. I've been travelling to Birmingham, to Manchester, to Bristol. I go and meet the agents. I go and meet the owners. There's this old adage, throw enough mud, some of it sticks. And that's what I do. And this is where you find the transactions. Plus the network, of course. So I've got my network and people come to me with various things. So we're hoping that within the next 6 to 9 months, we will find the right transaction and do a reverse takeover.
So Neil, after the first acquisition is signed and sealed, what's the plan for growth?
So the idea, as far as we're concerned, is once we've done that and we're looking for the second acquisition, the advantage we've got is if we buy a portfolio for, say, 40 million initially, it will probably be all equity. It'll be all cash. There'll be no borrowing. So when we look for our second acquisition, we are able to then borrow on the first one that we bought and use that money to buy the second one. So we won't have to tap the market so quickly in order to make our second acquisition. So we're looking like that. The second thing, which we think is very important, is that I am finding, only in the last little while, that some vendors are willing to accept shares as part payment and not just cash, doing a share exchange. And that might become more relevant because the budget is at the end of October the expectation is the capital gains tax will be increased. And I'm talking to some vendors who want to sell, but are not happy at what the CGT level might be. So we've said, well, why don't you take some of our shares and you can roll over the gain? And then they don't make the gain until they sell our shares. So that wasn't around a little while ago, but I've definitely noticed a sea change, and that might become more prevalent in the months ahead.
So I can see that your share register is an interesting one, with management from mining companies focused on Greenland, another one from an exploration company focused in Australia. So many of these names are familiar to retail investors. I appreciate they may have been there from the company's previous iteration when it was more acquisitions. So do you think that they are on board with the company's new vision and they'll remain on the register?
So when we took control at the end of January, I reached out to these shareholders. And the main shareholder in it, who was the promoter of more acquisitions, he's still there. And he's very supportive. And I've spoken to a number of other shareholders. And as you say, they're more into mining and energy and that sort of thing, and not real estate. So I've had to do a little bit of an education in terms of real estate. But they're all supportive. I've spoken to most of them. And what's quite interesting is some of the people who've come on the register is quite interesting. A lot of my friends have come on the register. You know, with some of them are not really into shares, funnily enough, but they know me. And when they ask what I'm doing and I tell them, and they say, well, that sounds quite interesting. And they go off and buy some. I mean, it's quite interesting how many have bought. So the existing shareholders are very supportive. I spoke to one only 2 days ago who lives abroad. Just to give him an update, he was a little bit naive, asked me to tell him what was going on, because I can't tell him, you know. But besides all that, but he was very supportive. And we're hoping that more people will buy our shares, come on the register, and join us on our journey, because we hope it won't be a dissimilar journey to what we did last time.
Many thanks. Neil Sinclair, Executive Chairman of Pristine Capital. Thank you very much indeed for joining us.